Okay, guys, so we're going to have a Fintech panel session on how do you get a startup off the ground. So can I just ask the panel to introduce themselves first?
I'm Andrew Lockley, and I mainly help startups get off the ground. So I guess I'm reasonably well placed to do this.
I'm Kirk Wiley. I'm the CEO of OpenGamma, a open source capital markets technology company.
I'm Conrad Ford. I'm the MD of Funding Options. Funding Options is a platform and channel designed to make it much easier for small businesses to access finance.
My name's Andrew White. FundApps, we make compliance monitoring software, so we love regulation, for the hedge fund, mutual fund industry.
Brilliant. Okay, so the first question I've got here is, what's the hardest thing about starting a Fintech startup?
Okay, well, the first point I'd make is that, I think probably the reason we're all here is because we believe that financial services is going to be has faced very large change over the next decade. I'm sure that's why we're all here. I would make a distinction. There's two very different types of financial services startup, in my view. There's the ones that are trying to replace the existing participants, so somebody like Funding Circle, who are trying to completely replace the banks in their existing role. There are the others who are actually looking to work with the existing providers, so in other words, help them embrace that change. So we've seen a number of those today. I think the challenges that you face are fundamentally different between those two, in my view. In the first category, the challenges you face are you're working with a regulatory environment that's fundamentally different to, maybe fundamentally at odds with your business model, and you also face the fact that you've got no brand, and trust is extremely important in financial services. In the latter category, the challenge, I think, above all else, and this is the challenge that I face really, because I'm in the latter category of working with the existing providers, is that they expect you to hold the standards of compliance, security, and operational robustness that they would hold. They rightfully expect you to hold that, and that has cost implications, and it also has implications in terms of experience.
Something that I would add to that is, especially compared to sort of consumer related companies, the minimum viable product is way higher, right? So, you're dealing with cases where money is on the line. If it's individual people's money, they don't want their money to go missing. If it's a bank or a hedge fund or something, you're dealing with, real money on the line. So, just setting up a simple web page with we're going to open beta soon, give me your email address, just looks really amateur hour, and nobody trusts you, right? So the minimum standard that it takes to get to anything that touches money, as opposed to something that may be just doing advice that somebody has to act on their own. The moment there's real money involved, the time for three dudes, three laptops, and Starbucks for a couple hours every day after work is just gone, right? The credibility, the minimum standard is way higher that you have to overcome.
Yeah, I guess I'm a good person to comment on that, since we've gone through exactly that, and we felt that it's been actually quite difficult to explain to investors and people like seed investors that why isn't the product out there? And it was like, yeah, but we're taking it quite carefully. We just want to see everything is working and getting the compliancy stuff in place. It's just something that a lot of investors, I feel, just don't understand, that it just takes more time. So I agree really 100% with that.
I think one really interesting experience for us was as we talked about, the brand reputation, about the no name behind you. You don't get fired for buying IBM. It is changing, and I used to sell software for 7 figures, huge bits of software that banks would buy like that. I thought it was going to be difficult going into hedge funds, even for 6 figures. But we've really experienced some hedge funds that took a web demo, did a bit of DD, did a bit of back and forth, lawyers and so on, and signed an agreement after 3 months. For a sizable 6-figure deal, where and then you get a day later a small hedge fund, a tenth of the size of the deal, and they're like, "Ooh, no, too risky." So there's a huge disparity there between open CTOs or open CIOs that are kind of, this looks pretty good. This does what it says on the tin, which is really important nowadays. You know, if it does what we need, if I can touch it, if I can kick the tires, if I can see with my own two eyes that it works and I get a good deal, and SaaS is a great way of de-risking the venture, because you can pay quarterly, pay yearly, pay half yearly, whatever. So they're used to 5-year lock-ins and all that kind of horrible stuff that existing vendors do. So it's really different. You can go to existing banks that are cool with it. You can go to small hedge funds that are not cool. So it's different, but it's definitely getting better for us. It's easier to change things.
I just think picking up on the comment around you can't do it as three guys working in Starbucks. I mean, the flip side of that is the companies. I mean, if you look at the number of B2C companies being created, because there is a low barrier to entry, there are huge numbers. I mean, I think there is a romantic view of how things like Facebook get created. I mean, the reality is, for every Facebook in the B2C space, there are literally tens, if not hundreds of thousands of companies that fail. So when you approach something like this market, yes, it's more difficult. Yes, you have to have an integrity both in the founding team and your approach to the market. You don't necessarily need in B2C. I got a cool idea, I did it, works in B2C, and that clearly doesn't work here. But the types of company you can build as a result of that are very different. The underlying value of getting a fintech company into the market and selling to customers is very different to your average B2C. Now, obviously there's outliers with B2C and some are very successful, but certainly from a founder's point of view, there is a fundamental nature of this type of business that will set you up for a longer term than a B2C.
Yeah, completely. I mean, I wouldn't be doing it if I didn't buy that. I think the barrier to entry, it's a hard thing, but if you can overcome it, one of the things that I like about this industry is that the de-risking cliff is you reach a couple milestones and everybody kind of knows what they are, and from an investment and company perspective, it de-risks pretty quickly. So you have that initial hurdle, but then it de-risks very quickly, and once you get a few key customers, you're not going to end up realizing that you've pulled a MySpace and all of a sudden 90% of your customers are gone in 6 months, right? Like that just doesn't. It's a great business to be in if you can get over that, but I think that's the hardest thing I've found is that cliff.
Yeah, one really key point that hasn't been addressed, and I think most of the key differences have been addressed, but one point that hasn't is the way you sell. And there's a really crucial difference that I think most people in the fintech space perhaps don't realise, is that a very, very large number of businesses outside the fintech space, you can sit in a box and build it and never speak to anybody. And that just simply does not happen in fintech. If you can't go and put a suit on and go and talk to people about money, then you're not going to get anywhere in fintech. But you can do that kind of thing and sell shoes or whatever, and it really doesn't make any difference. You can do it all over the web, but fintech's absolutely not like that.
Well, no, it's actually from the previous comment, but there's a funding gap for fintech. It's easy to find angel money. VC's not VC anymore, right? It's expansion capital, and the VC doesn't take any V anymore. And for a lot of fintech, it's smart technology, the people who know what they're doing, but they need the funding. They're used to having the funding from wherever they used to work. And this is something that we've looked into, is building a fintech fund to focus solely on this, because in the funding world, very few people actually understand financial technology. They understand the new kind of app that does something that, that hails a taxi for you. Brilliant, I understand that. That's cool. But yeah, if it's, some sort of specialized piece of financial markets, very few people understand that, and finding that, filling that funding gap is really hard.
I think there's a moment in KCI and a couple of banks. Good. I believe, if my information is correct, that one of the large incubator runners is going to run it for them. Because, clearly, if you look at the economics of this country, we're actually pretty good at banking, is the reality. and to not focus the attention of startups in an area where we have a huge amount of skill, a huge amount of credibility, doesn't make any sense. So I think that people are aware of that, and certainly I've heard rumours, although I haven't actually seen anything come out, that UKTI are doing this and are trying to pull together some interest in it at the moment.
I was actually at the kickoff meeting for that at the
behind the curve.
Yeah. So interestingly, I was one of the fintech startup CEOs that was there, and one of the things we pointed out was, unlike the kind of New York accelerator program that was based on, money really wasn't the kind of concern. The amount of money that they were thinking of offering, even as an honorarium, would set a valuation expectation that was actually radically low for a company that had the standards that they wanted. It was more the introduction, the incubation, the learning how to sell, the learning how to, take the hoodie off, put on the suit, and go in front of a Hong Kong businessman that if you wore the hoodie would kick you out of the room. Interestingly, we've done 2 rounds of venture capital, and we actually started with slideware. There are funds that will do it. So Steve Gibson from Euclid Opportunities isn't here tonight. I wish he was. He actually has a small, very early stage VC arm that's actually funded by ICAP to help cross the gap. But one of the things that I found coming from a Silicon Valley background and then working here in London is, so a lot of the European VCs have realized that if they want to be serious about funding technology in London, they have to fund finance, right? This is, this is the dominant thing. They kind of have to do it. And so, companies like Excel, Balderton, Index have started putting internal research dollars at specific areas that they think are ripe for disruption. And when they see the right opportunity, they'll go after it. But you also have to kind of understand the VC mentality, which is, somebody like an Index or an Excel or a Balderton that's raising, $200 to $500 million LP rounds, they're in exit. Basically, they have to invest, every single company they invest in, they have to look at it and say, that's a potential $1 billion exit, right? So, and somebody, I think you have a very good business, but there's, I can say that somebody like Bruce at Excel would not look at that, because if you're saying, this is our exit, 5 years, this amount, that's outside their kind of investment criteria, right? And so, there is appetite for it if you are packaging up what they want to buy.
Yeah, I would say the same thing. So I've personally sensed that there's a big shift and a big awakening around the financial services opportunity among larger angel investors, around the more early stage VCs, and I think it's because there is a growing talk around financial services as being one of the great disruption opportunities of the next decade. So anybody who reads the press, the tech crunches, knows that that's happening. So I think they're beginning to tool up. But yeah, there's no question. You do speak to some venture capital firms, and there's a clear lack of understanding and market knowledge, and that's understandable, of course, because we are in one of the most specialist industries there is. But we've talked about Euclid. There's also Anthemis, a specialist in financial services. They really know what they're talking about. If you're not talking to them, you should definitely be talking to them. And there's the London Fintech Fund is on its way. So there's a growing thing. But I think within the larger VC firms, they're really waking up to the financial services opportunity. Whether it's soon enough for the people in this room, I don't know, including myself in that, by the way.
Yeah, I just want to offer a perspective again from kind of bridging from fintech into other areas of the market. I think it's reflective of just how poor Britain is at VC funding, that we have the world-leading banking industry and we're still talking about a funding gap. Surely anyone can see that that is a really crass situation to be in. We really need to wake up and smell the coffee when it comes to funding. The last thing we want to do is have a situation where the Yanks are taking the opportunities out to the valley that we should be executing in London here, because there's no reason for fintech startups to be going out to the valley to get funding. It should be, the ecosystem is here. It's within a mile of this building, right? So there's no point people thinking about if you're going to start some social media startup, then by all means drag it out to the valley. That makes a lot of sense. But for fintech, we should be building an ecosystem here and not settling for second best in any way at all.
There's just one other point I'd make. There was an organisation set up recently called City Meets Tech. I don't know if you've heard about it, but City Meets Tech, the idea is that startups get a pitch in front of a range of wealthy individuals from the city. And for me, that would be the perfect opportunity for fintech startups to pitch to people who might actually get it and actually be buyers within these organizations. So for me, and that's not what it's doing, to be clear, for me that's what really should be happening. Rather than pitch to people because they've got deep pockets, pitch to people because they're the guy who runs that in Deutsche Bank. That's what you want, right? And I think that will be a wonderful thing to come out of this organization, by the way. I think that kind of networking between the buyers who actually buy these platforms that we're all looking to build and the people who might actually have the solutions that are going to be relevant in 5 years' time.
We have three recent news. One is the computer glitch in the these banks, which has stopped the transaction for the RBS and Halifax, I think, for last 6-7 days. And we have another news in the newspaper that one farm alone has lost $800 million because of the cyber attacks and all these things. So my question to the VC fund, with the
I'm not a VC
gentleman.
fund. None of us are VCs.
Anyway, so what do you think the prospect of having this type of farm which protects the cyber attacks, and whether we can start a company? I can offer anybody here who can join me in starting this fund, which will take care about this type of cyber attacks. And equally the government, Ministry of Defense also very much, because of the future cyber attacks that is coming up, which is be more dangerous than the real war. So can you give some idea about this thing?
So my personal opinion on this is that I think security technology is one of the more overfunded areas of technology, and I think it's best to be left to the security technology professionals. And are there any here? Yeah. So I think we're probably the wrong crowd to be asking.
I've got a comment I'd like to make on that. One thing I think is really interesting, and it's not quite directly an answer to your question, but I think it's about setting the right environment for doing business in the UK. I think it is a disgrace how bad the police are at pursuing cyber criminals. An absolute disgrace. We cannot build an economy based on digital technology if we don't have a secure space to operate in. And when the police just can't understand computers and stop at our own borders, we are unable to have effective policing of the digital space, and we cannot move forward as an economy. We can't protect what we're building here if the police don't raise their game and start moving from the 19th century into the 20th, and maybe even on one day the 21st.
Okay, that actually took about 20 minutes, which is good. The next question is quite straightforward, and I think you guys are very well placed to answer this. What are the most common mistakes that fintech entrepreneurs make? You've all tried it before.
I've seen one common one, and it goes to, especially if you're seeking funding, which is we live in a world every day where we all understand what we do, and I can explain what Open Gamma does to anybody in this room in 2 sentences, and you'll kind of get it and it'll click. And you kind of have to learn to explain what you do to your grandmother in a way that isn't patronizing. And that's a really hard thing to kind of jump out of the jargon. And I had to give, for the last time we raised funding, I had to give so many prep pitches to avoid going into jargon, to avoid, trying to explain what we do and the disintermediation and all of that, especially for us because we're in pure capital markets. I see a lot of people who come in and, they're giving a VC pitch, and it just sounds like they don't understand the target audience, because the people, they may understand finance is big, making money is big, but you throw out all the details and the nuances of what we live every day, and they don't get it, and they kind of blow their chances.
Yeah, I mean, just on that point, I actually ran through an investor deck for my company with a friend of mine who's a VC partner, and he came to the end and he said, just stick more logos in it. Just of your partners. Is that level of understanding when you're trying to convince a room of partners who have an hour to think about your company, stick to the really simple stuff. My comment and answer to that question would be, I think I'd come back to something that was said before, that I think a lot of people who start up financial services startups forget the fact that the barriers of entry are quite high, and therefore the hurdle you need to get over initially is much, much higher. So, you can't, the number of financial services startups that come out of nowhere with one guy in a room, one guy in Tech Hub, very, very rare. So I think you need to climb higher quicker, but once you're over that first hurdle, the world is much more attractive than it is for a consumer startup. So I think you need to be tooled up at the start, basically.
I think one slightly out there idea is that startups or fintech startups should be a little bit more bold. I think a lot of them do try and model themselves in existing companies. They try to be the next SunGard, the next Fiserv, the next Charles River, because they believe that they need to be safe and they need to have nice branding. And I see startups that I know have got 5 people and they've all got the About Us page with lovely suits on, and they describe themselves in really professional tones. I think there's a little room. I think people are a little bit more informal nowadays. You can be a little bit more honest, and if you do come up with something slightly newer, slightly more exciting, there's an opportunity there. I hate to see all these people that just basically are doing a little bit of newer tech but trying to copy an existing company. So I think Holvey and people like that, there's absolutely room for new stuff, and we might at the beginning say that's a crazy idea, that will never happen, but look at the PayPals. A lot of stuff has happened with people that did dream a bit higher than the rest. So I think people need to be bold. People are changing. CEOs of banks download stuff on their iPad every day. They realise, what's the risk in this? I can pay £5 and download something, so I can take a risk on software too. So the mindset is changing, and we need to support that and not always think in the same patterns. One good example we had was a very large investment bank came to us, and they tried to persuade us that the cloud wasn't the way to go and they wanted it installed. I saw big dollar signs in my eyes, and I was like, yeah, let's do it. And the CTO was a little bit younger, a little bit more, shall we say, idealistic, and he was like, I really don't want to do this. And I'm like, okay. Ran off to Mayfair, went in, said, no, we're not going to do an install solution. And we persuaded them, and now they're an existing client using the cloud where they said they wouldn't. So, you have to stick to your guns and do something new.
Yeah, this is something that applies generally, but it's just as true in fintech. I really think that the Achilles heel of many startups is that to a man with a hammer, all problems look like a nail. If you're a coder, you think the solution is better coding. If you're a software engineer, you think it's better software engineering. If you're a marketing guy, you think just selling stuff and then waiting for someone to magically build it is going to be okay. To me, the stronger teams, the teams that actually deliver, are the ones that have either hugely multi-talented individuals that can fulfill a number of roles, but much more commonly a group of people who are complementary, understand each other's specialisms, not to the extent where they can execute those, but at least to acknowledge what other people bring to the table. The startups that terrify me are the ones that have unknown unknowns. If you've got a bunch of people in a room and they're all the same age, they're all from the same town, they're all the same race, they're all from the same culture, you just think there's so much you don't know, and I don't want to put my money anywhere near you.
Yeah, I wanted to continue that on that theme. It kind of ties to the previous topic as well, because you were all talking about that you need to dress up in suits to be able to work in this industry. But does that mean you're all thinking of sort of fintech as a B2B business and not as a B2C business? Because actually, if you're going out there to talking to consumers and groups who want to use new services, they're actually their feeling is quite negative towards banks at the moment. So, anything that's different from that is actually a good thing.
For me, all I sell to is banks and hedge funds. So, most of the, this is me day to day. I didn't have any advance warning, so this is just how I come in. I'm one of the more dressed up people in the office. But if I do go into a bank, I do have to look that way for that particular transaction. And the moment I'm gone, jacket comes off and I kind of relax. But completely, if you're not selling B2B, if you're not selling into that corporate world, then I wouldn't wear a suit and tie. You look like a banker.
Yeah, I mean, this was kind of the original distinction I made at the start. There's some that are working with the existing providers and some that are trying to replace the existing providers, and I think they're fundamentally different things. We just happen to be both in that camp.
I just want to link in the kind of comment about personal presentation with the previous comments on the panel and the last question. And that, I do think that people are looking for a different branding experience. And if you look at the banks that have been genuinely disruptive and successful, even in the last couple of decades, people like First Direct, Egg, Metro Bank, they've all been disrupted because they've said, we're not the same as everybody else, we're doing something different. And even banks that are trying to reposition themselves, like NatWest, have gone on almost a kind of, hey, we're not really NatWest anymore exercise over the last few years, and sure as hell they are NatWest, I deal with them. Yeah, they're kind of tolerable, but
yes.
yeah. But I do think, yeah, sure, if you go into a big staid old school bank, you do have to play their game if that's your customer market. But I think that the fundamental question is, when you're addressing consumers, can you be different? And absolutely yes. And that's been at the core of some of the stuff that I've done in the fintech space.
It's more kind of an observation. I started off in the internet space back during the dot-com bubble and ended up working in the city, both in institutional and more recently on the retail end. One of the things that I noticed back in the kind of 2000s era is that a lot of the startups, the successful startups that came out of the financial space then, so people like Market Access, Market itself, Ion Trading, they were all started by financial industry insiders, people who leveraged experience and relationships that they already had. Quite often, those sorts of companies were funded effectively by already having customers in place when they launched. Not all of them were obviously successful, but the ones that did go on to become 100 million, over $1 billion in terms of valuation, were founded by insiders. These days, I've been seeing more people coming in to try to launch fintech startups who don't have a background in that sector, and some of them are very, very naive. They don't understand the sector. They don't understand the nuances and the details of how banking or a particular aspect of financial services is driven as a business. And I think that until we've had a few high-profile failures and that becomes acknowledged, that an understanding of the sector is necessary in order to be able to successfully launch a startup in it, then that's going to continue, and there's going to continue to be a funding gap in terms of people not necessarily being willing to invest in startups, in founders who don't understand the business, clearly don't understand the business. Another problem that I've seen is that you have self-professed experts who speak as if they have got experience and a track record in financial services, and on some occasions when you dig a little deeper or scratch the surface, you find that they have no background in fintech or financial services whatsoever. And I think that's something that startups need to be very, very wary of if they're bringing on board advisors or even people who are just giving them advice or trying to make introductions. I think it's an area that is very, very different from the traditional tech startup world. And I think that trying to apply the same principles that worked for tech startups needs to be done very, very carefully, because there's a massive crevasses that are just waiting to grab and trap unwary founders and entrepreneurs.
If I could just address the kind of first thing there, I mean, so yeah, if you're in certain areas of financial technology, massive amounts of domain expertise on the team are an absolute requirement, in particular capital markets. If you cannot walk in to the head trader at a hedge fund or the guy that runs a desk at a bank and speak very knowledgeably using the jargon and being able to go really deep in the technology and the business as required, you're not going to do very well. You don't come in and say, I'm going to build a derivative trading system and I've never spent any time dealing with derivatives. I mean, I've seen people who said they're going to do it, but they're completely irrational. But I think some of the more interesting things that I've seen are in the B2C space, or where C is not a financial institution, are the converse. I think it's people coming in and saying, you know, actually, I'm a layperson. I'm going to design a product experience that's how I would want to consume that experience, and then I'm going to surround myself with people that know how to get things done, right? So, you know, I think Square, Bank Simple, some of these, you know, admittedly they're all Pac Northwest companies, but there's something really interesting coming out of in the B2B space where the B is not a bank, and this B2C space of somebody coming in and saying, actually, the fact that I'm this rank outsider gives me a kind of product knowledge that I wouldn't necessarily get otherwise, as long as you can then add in the domain experts that can get you your FSA funding, can negotiate your merchant accounts, can do all the nitty-gritty that kind of has to get done. But yeah, if you don't have enough domain expertise, there's no point in doing anything capital markets related at all.
I just want to make a comment on that question, because I will happily put my hand up and say I'm a rank outsider on most of fintech, but I'm a rank outsider on virtually all of the areas I work with people on, because the thing is, to make a balanced team, you don't need everybody to have that really detailed experience of the particular niche that you're going into. So much about business is, you know, how do you structure the successful growth of your company? How do you go and acquire customers? Now, you know, that's pretty much the same for a shoe shop as it is for a fintech startup. You know, that there are so many areas of business where you've got huge parallels between completely different sectors. A lot of the knowledge that, you know, speaking from my own point of view, that I bring is very much that kind of cross-sector experience. Absolutely, you do need people who know the very, very deep detail of each individual market you're going into, but that won't get you home. You know, you have to have that broadly experienced team who don't lack the detail, but also have the expertise from other markets. There's a guy called Jay Abraham. You might have come across an American sort of business and motivational speaker, and he came across one of the smartest comments I've ever heard in business. He said, if you want to be as good as everybody else in your market, look at your own market. If you want to be better than everybody else in your market, get people from outside your market and bring them in. And that I really live by that.
I just have to agree with the two. Sorry, agree with the two lads there. And kind of on the Harvey lines and the suit, I think certainly if we're talking London here, we can't ignore, and I'm sure David will agree with me here, the old boys network on that. There is still a huge amount of networking and of people you need to know to get the appointment with the person. That's important, and that no matter how good your technology is, it's always going to be difficult to get in that door. And I think to your observation, I mean, that's where you do need an experienced person who can call in a couple of favours, and you know, for the time being, that's going to be the way. You stick on the suit and you go and you talk to the people and you have drinks afterwards. And you know, there is a huge stuff that you'll never learn on Seed Camp, and you'll never learn on bloody reading TechCrunch. And what Mike Butcher says, you know, you need to be able to talk and drink and, you know, walk the walk in the city. And you know, that's not something you're going to learn anywhere else but other than doing it. So, yeah, absolutely.
Just I'll close very quickly. Next meetup's on last Tuesday in July, which is July the 31st. Thank you for all the presenters. Thank you to our illustrious panel. Thank you to the attendees. Thank you to Anna, Sherry, Elliot, and myself.